Hey everyone, welcome back to Corporate Decoder, the place where we decode the dramas behind corporate America. And today's filing might just be more dramatic than a season finale. Get ready to dive deep into Trans-American Aquaculture, Incorporated's latest quarterly report where we'll unpack their financial health, their surprising challenges, and what it all means for the future of this aquaculture company. Make sure you are subscribed to Corporate Decoder because we break down these dense financial reports so you don't have to. And hey, if you want to chat about these filings or anything else, corporate join our Discord community. It's linked down below. Alright, let's jump right into this filing from Trans-American Aquaculture, Incorporated, otherwise known as TAAQ. This is an amendment to their quarterly report and update after their initial filing. Usually amendments signal corrections, and that is indeed the case here. The company is restating some financial information primarily to fix minor issues with balance sheets and stockholder equity. Nothing too alarming so far, but it does mean we need to be extra careful when looking at the numbers. First up, let's look at their financial snapshot, the balance sheet as of the 30th of June 2025. Total assets are about $1.08 million. That might sound small compared to giant corporations, but for a company focused on aquaculture, it is a decent size. However, when we look at liabilities and stockholders, equity things get a bit more interesting. Their current liabilities are over $4.6 million. That is a significant amount, way more than their current assets, which are just over $300,000. This gap highlights a potential cash crunch. And then we see a stockholders deficit of nearly $3.8 million. Ouch, this means the company owes more than it owns on paper, which is T-ideal. Now let's look at how they performed operationally. For the 3 months ending the 30th of June 2025, their revenue was $00. Yes, you heard that right. Last year in the same period, they had over $5,000 in revenue, a 100% drop. The same story plays out for the 6 months ending the 30th of June 2025. Total revenue was $0 compared to over $315,000 in 2024, a 100% decrease. This means their cost of revenues was also $0 in 2025 compared to over $1,700 for the 3-month period and over $223,000 for the 6-month period in 2024. Consequently, their gross profit is also $0 for both periods in 2025. This is a serious red flag, folks. While they had no revenue, their expenses continued. General and administrative expenses were over $108,000 for the 3 months ended the 30th of June 2025 and over $182,000 for the 6-month period. They did manage to reduce these expenses compared to last year, but with no revenue, those costs quickly add up. The bottom line is a substantial net loss. For the 3 months ended the 30th of June 2025, they reported a loss of over $204,000 compared to a loss of over $330,000 in 2024. For the 6-month period, the loss was over $317,000 compared to a whopping loss of over $568,000 in 2024. Simply put, this company is burning through cash and not generating any revenue right now. This cash burn is clearly shown in their cash flow statement. For the 6 months ending the 30th of June 2025, they used over $716,000 in operating activities. This was primarily driven by their net loss and increases in things like accounts payable and accrued interest. Their investing activities also consumed cash, though much less. Financing activities provided them with some cash, but it is not enough to cover their operational shortfalls. For the 6 months ending the 30th of June 2025, financing activities brought in about $699,000. This mainly came from the purchase of preferred stock and reclassifications of related party notes. And the result of all this, as of the 30th of June 2025, their cash and cash equivalents were just $198. That is right, $198. They effectively had no cash to operate with at the end of June. This is a critical situation. So what is going on here? The company underwent a significant change in 2022 with a stock purchase agreement and a reverse acquisition where Trans-American Aquaculture LLC became the accounting Aqua. They operate a land-based shrimp farming business. They produce premium quality shrimp. They believe they are a leading aquaculture company. However, their report also mentions they are not currently in full compliance with best aquaculture practices guidelines and are working towards it. Seems like they are aspiring to greatness, but are still a ways off. Their debt situation is quite complex. They have various notes payable, including a significant note to former farm property owner and promissory notes to lenders like 1800 Diagonal and Arcadia Funding LLC. What is really concerning is their mention of filing for Chapter 11 bankruptcy protection on the 2nd of December 2024 in the Southern District of Texas due to threats from a former farm note holder. This bankruptcy filing is a major event indicating severe financial distress. They have been trying to raise capital through an equity financing agreement with GHS Investments LLC. This agreement allows them to sell shares of their common stock to GHS at discounts to market price. They've also been selling Series D preferred stock to GHS and issuing warrants for common stock. These are common strategies for companies that need cash, but they often come with dilution for existing shareholders. All these financial pressures lead to a very direct warning in the report. Under the heading Going Concern Uncertainty, they explicitly state that there is doubt as to their ability to continue as a going concern. This means it's questionable if the company can survive the next 12 months without significant new funding or a successful restructuring. They admit they will require additional funding to finance growth and achieve strategic objectives. This is a very serious statement from management. The lack of revenue is explained by the company only maintaining broodstock for future genetic development and stocking. They did not have shrimp for sale. Their business is described as seasonal and they are currently only maintaining broodstock lines. They plan to refresh these lines in the fourth quarter of 2025, but this depends on investment funds being raised. Essentially, the entire operation seems to be on hold, waiting for money. This entire situation paints a challenging picture. The company has substantial liabilities, virtually no cash, and no revenue generation during the reporting periods. While they have plans and agreements in place to raise capital and restructure, it is all contingent on securing new funding, which is a significant risk. The Chapter 11 bankruptcy filing on top of extremely low cash reserves amplifies this risk considerably. Looking at Transamerican Aquaculture Inc. Here is my take. This company is in survival mode. The zero revenue in the first half of 2025 combined with the bankruptcy filing and minimal cash is a huge alarm bell. Their strategy seems to be focused on rebuilding and securing funding through preferred stock sales and potential new investors. The future hinges entirely on their ability to navigate the bankruptcy proceedings successfully and attract the necessary capital to restart operations. The risks are immense. The success of their broodstock refresh and their ability to secure strategic partners will be key metrics to watch. What is your take on TAAQ situation? Are they on the verge of a comeback, or is this a classic case of a company struggling to stay afloat? Let me know your thoughts in the comments section below. If you found this breakdown helpful, please hit that like button, it really helps us out. And if you want more of these corporate deep dives, make sure you subscribe and ring that notification bell. Don't forget to join our Discord community, it's a great place to connect and discuss these reports further. Thanks for watching, and we'll see you in the next episode of the Corporate Decoder.